Hey, what's up, guys? This is Nick from Surge Traders, and today we're going to be going over the stock RSI and the RSI indicators in general and how to use them properly. So just the basics of the RSI, how it's put together. It just compares the recent gains with recent losses, and by doing that, it determines whether something is oversold or whether something is overbought. And then it's just on a scale from 0 to 100, and from there, when something is over 80 for the stock RSI, it's oversold. Something's under 20, it's overbought. When something is under 20, it's oversold. And then for the basic RSI, when something is over 70, it's overbought, and when something is under 30, it's oversold. Now, the difference between the stock RSI and the regular RSI is that the stock RSI has the stochastic, if I'm saying that right. It uses that formula with a set of RSIs instead of just the standard price data that's the RSI uses. So that's kind of just the basics of it, just how it's computed. So very typically, when something is overbought, that means it has a high number, high pressure, and then it has a more likely move to sell off. When something is overbought, it has a more likely move to sell off. When something is oversold, it then has a higher chance of not being sold off as much and then moving up from oversold to overbought. Typically, it is thought that something that is overbought is then bearish because the buyers have come in. It's had a lot of buying pressure. It's run up a lot. So therefore, when something's overbought, it starts to enter into the bullish territory, and that's half true. We'll get back to that. And then when something is oversold, it is then in the bullish territory, because when something's oversold, you've had your high level of sellers. It's been pushed down. The price has dropped a lot. And then it can then make the move from oversold to overbought, which is a bullish move. Now, the thing that I really want to go over is the huge misconception. Actually, one of the tickers, I asked you guys for tickers earlier, and I only got 3 suggestions, but I'll use those 3 charts, those 3 tickers, for what we go over in the lesson. Ruby, RUBI, was the first to be asked about. The reason I'm just going to do the tickers you guys asked about is because I don't want to have like this perfect chart set up where, here, let me show you the stock RSI when it's working perfectly. I kind of just want to show you on everyday stocks or whatever you guys are actually trading to show you this applies to pretty much everything. I'm happy someone said UNG because I want to show you this works on commodities as well. So, the basics, when something is oversold, you can see here it is, it's oversold, and then it has the drop to overbought. Sorry, when it's up here, when it's above 80, it's overbought, it's up, and then when it drops to oversold, then you have a drop in price. You can see it big time up here. You see it's overbought. Then once it reaches these levels, it can drop very far down once it hits oversold. Now, the misconception is that once something is oversold or overbought, I gotta stop messing that up. Once something is overbought, it then becomes bearish. So for example, Ruby, actually right now, a lot of people would say, oh yeah, this is now bearish. It's overbought. Here it is. It's maxed out literally at 100. RSI is above 70. It's overbought as well. This is for sure overbought. It's now bearish. It's ready to come down. But that's not the case at all. It's slightly true, but not really. It's almost quite the opposite. And this is where a lot of people get tied up and where a lot of people get really messed up when they're using the RSI or the stock RSI. This is something that can just really bite you in the ass. When something crosses from a negative to positive, that is bullish. So when it comes from under the 20 and it crosses the 20 mark, that is a bullish cross. And then once again, if it's under the 80 and it crosses the 80, that is an additional bullish cross, not a bearish cross. This is bullish. So when the only time it reverses is once it breaks under 80. Until then, it's in a completely bullish trend. So anytime it becomes bearish, so when it breaks under 80, otherwise it's a completely bullish trend. So here, once again, you see it breaks here, it breaks up here. And if you look, if you're in this situation where, oh, it's oversold, it's ready to drop, it's ready to come down. If you did that right here, you're going to start shorting at $13 and find yourself up here at 18. Look at this as, like I said, a bullish cross. When this comes up here, stocks, they do a very, very large majority of their run while they're overbought. That is excellent. When something is overbought, it is then in a bullish trend. And that trend is not over, and that bullish trend does not end until it breaks under the 80 mark. Think of this 80 line as literally a support line. This isn't some danger zone. This is, no, you now have a new support line. It's just once it's in here, it's much shakier because you have huge range that can play as to where once it's up here and down here, one side of the scale just gets tipped so far that's when it goes into the trend. Once it breaks up into 80, you now have so many buyers coming in. You have so much short covering. You've now entered, just slid right into a bullish trend. And that's why if you look here, look at this. This was overbought all the way from 1326, coming all the way up here to 1820, okay? And then once again, it becomes bearish once that 80 line breaks. Then it's bearish. And here, it most likely happened on this huge candle, I'm assuming. So even if you were if you're playing this, you would have waited till it broke 20. It broke 20, you enter, you don't sell when it's oversold. You keep riding it, going, and then boom, once it breaks 80, that's when it's bearish. And then once again, when it breaks 20, that is not bullish. It is not oversold, ready to pop. No, you have now just confirmed your bear trend. You're now in a very bearish trend. So we coming down here, it breaks the 20 line, and then all of a sudden, here it goes, it's coming up. And then once it breaks the 20 line, then it's finally going up, and we're in our bullish trend. And then once again up here, you see it's oversold, overbought, and then it just keeps going. As it's overbought up here, it just keeps running. And then once it breaks the 80, I think is actually on this red candle here, breaks the 80, it's in that bearish, bearish trend. And then once it comes back up, see here, it didn't dip under the 20, so you might not have gotten in on this entry. But once it broke this 80, then you could have gotten in again. I'm gonna check the chat room really quick. There's like 40 new messages. Okay. Not much. All right, cool. So yeah, and you can just see this pattern. It's very consistent. And once again, here we go. We can literally start from the beginning. When it breaks, it goes up into this nice run. And then once again, once it breaks here on the 80, it drops down. And then, like I said, these areas can be really tough to play actually. Like when it breaks this 80 here, and even though it starts reversing back up, you're shorting it, and then you're gonna probably break about even until this drop up here. And the reason this is tough is because it doesn't drop below the 20 line to really give you that full confirmation that it's reversing back up. So the way to play the longs in that situation is if you are on the long side, once again, you kind of have to just wait until here, and you have to wait till it just breaks there. But then once again, so sometimes, I mean, when it's in choppy, like a sideways, it isn't always the best. You know, it's not going to always perform to its absolute best abilities. But once you ever get into these trends, that's absolutely when this thing starts killing it. So once again, you see here, once it breaks the 80, it tanks all the way down pretty quick. stays below, and it's just dropping. And then once it finally breaks up here, you can long for a little bit, and then it drops pretty quick back down again and keeps on going. And then look, like I said, as long as it's under there, it's going to keep trending down. Same thing. It breaks under 20. And then think about it, if you thought, I feel like I see in the chat room a lot, is why I'm emphasizing this, because I'll see people say, oh, it's oversold, it's bullish now. But if you try to long here at 1560, well, it was technically bullish all the way until $13, which is putting you in the hole, because by the time it even makes its run up, what is this, 4 or 5 times, you're about even. And you most likely weren't going to hold for these 2 months right here. So then let's go to UNG. What's the next request? Actually, I'm going to just do natural gas futures, if you don't mind. Oh, never mind. They're all ugly from the newsletter. Okay, we're going to go here. Same thing, though. Look, once it breaks this 80, it just keeps declining. And then while it's over, once again, you think oversold. Oh, it's oversold. It's ready to come back. No, it's just declining. It's just dropping. This bearish trend, and it's just going to keep dropping until it finally can break that line. Also, to answer a question I know I'm going to get, you're going to want the difference between these two lines is you have the K and the D line. I have my K line as the whitish yellow, like off-white line, and the D as the blue line. The K is the K period. It's just it's based on faster data, more current recent prices. So it's going to be a little bit choppier, but it's going to be a little bit quicker. You can see here how the D is all the way up here at 73, and the K is at 46. So it's going to be a little bit quicker, a little bit faster on the action, and then the D is using longer time frames. So it's going to have a bit of a more for sure trend, as to where the K might get a little bit choppier on you. And so then it breaks the 20 here, and then that's when you can long, going up, and then once it dips down to about here where it breaks the 80, then you can sell. And then once again, if you want to short there, you can do the inverse DGAS, riding that all the way down until it breaks up, and so forth. And these trends work for everything. Let's go to Amazon now, the other ticker that was requested. Same thing. Here we go. You break the 20, it's running up, and it stays running until it breaks the 80. Then it comes crashing down. And then once it breaks the 20, you have the confirmation running up, going down, up, down. It's fluid. But I just really wanted to emphasize to you guys how important it is that once something is above these lines, it just stays in that trend. The trend just continues. It doesn't end. That's why I get a lot of questions when I post some of my charts. People be like, Nick, that's really oversold. Like, why are you longing there? And I'm like, that's a bullish trend. It's looking excellent. And like I said, same exact thing works for the RSI. It's just a little bit slower. As you can see here, as it goes from one cycle of oversold to overbought, the RSI goes 1, 2, and then 3. I guess that's 2 full. So 1, I guess 3 full almost. So you can see it's just a little bit quicker. The RSI is going to give you longer, drawn-out trends, as to where the StochRSI is going to be a little bit quicker on the action. And this works for all time frames. It's not just the day, not just for swinging. Same thing. Once again, once it breaks, it comes up here. Usually it's going to open kind of up or below. So that's why I like to look at now after hours. When you're looking at the volume, after hours doesn't always have that good a volume. So I wouldn't always trust it that much. But pre-market, about 30 minutes to an hour before the market opens, it's going to have really good volume, and then your indicators are going to start working up again. Because indicators are really heavily dependent on volume. So unless you have really good volume, then it can get kind of shaky in there. Now, the trend, okay, hang on, let me check the chat, and then now that I've given you this information, how do you use it? So I'm going to answer that in a second. Let me check the chat really quick. Yes, this is applicable to Forex. Yes, break of 80 means get out. Remember, these are support and resistance lines, guys. So the 20 is a resistance line. So until it breaks the 20, you haven't broken resistance. You're just facing resistance. So just look at these all as support and resistance lines. You can see it even bounces off the 20 here, doesn't even break. And you'll see sometimes it gets rejected at those lines too. Or when it's up in a trend, it'll bounce off the 80 line a little bit as a support and keep running. So just look at these as support and resistance lines, okay? Yeah, it applies to pretty much any time period, any time frame. Here, let me go to, here, oil is literally live right now, so I can show it to you. You'll see starts on here. Just look for the break of the 20 and then once the 20 breaks, it'll start moving up. Just remember, the 1 minute time frame is much choppier than the higher time frames. So it can do, oh yeah, like we just saw, it can come up and down. So until the candle closes, it's not always confirmed on the 1 minute time frame. And that's just because it is choppier. It's the 1 minute. But you know, it can work all the way until that level. For the K, I use 11, and for the D, I use 2. Yeah, the fast and slow, it's literally just the amount of time frames being used, amount of periods back that it's looking, typically. That's usually the big one. And cool. And I use all default settings. I don't change anything. StochRSI is default 2080 and RSI is default 7030. I didn't change them from each other. Yeah, it always makes sense to wait and confirm. I don't enter if something's below. I don't like entering below 20. If it's below 20, I know that it's in a bearish trend and it can just keep dropping long for indefinite period of time until it comes up above the 20 mark. More valuable. I mean, I think everything can be used with each other, and the beautiful part about technical analysis is how it accents each other. And so, I personally do like the RSI and stock RSI more. I don't use Bollinger Bands that much, and I don't even use Fibonacci at all. I literally 90% of what I use is moving averages, stock RSI, and MACD, and a custom indicator that I built. That's about what I have. That's about what I like to use. Okay. Now we're going to dive into this. We're going to go into how to, okay. I think unless you look at a lot of, yeah, I mean, you can watch for the perfect storm. I saw one earlier. I got Ruby right here. I mean, you get some really good looking stuff. This, oh my, right here. Look at this. This is like the Steph Curry moving average pattern right here. You got the 10 above the 20, above the 50, above the 100, above the 200. And it's in a bullish state. So, I mean, these type of things, when you have stuff looking like this, I mean, they'll just run. Stuff just can just run, and it can just break open at that period, at that point in time. There isn't really much. I mean, sometimes, you know, there's factors like, you know, it's at the 52-week highs, so that can bring it down. But I mean, if this wasn't at 52-week highs and you were looking at some sort of gap up, or like a long-term gap up of any type, when you see all the moving averages stacked like this, that's just pure perfection. That's why it's called the Steph Curry moving average pattern. It just can't get any better than that. And so it'll just run, and it's just pretty much as bullish as it can get. Now, okay, how to apply this to trend changes. This is what we care about. How to actually apply this, how to make some money. So there's always some things you want to do. The first is you want to kind of identify what a gap up. Okay, yeah, sure. Gap up. Here's a gap up. when something drops heavily and then it comes back up to the drop point. So when this dropped all the way here and then came here, it had a huge gap fill that day. Slowly came up and then a huge gap fill. And you can see it leveled off there, and it just, you can imagine this just like filling up type thing. Pretty basic. And you could have gap downs. So it could be like here, it's up here and then it comes all the way back down to there. That's a gap down. Comes up, comes all the way back down, gap down. And then since it was here and it came all the way back up to there, that's a gap up. Since it dropped down to there and it was down to like here, gap down. When it's here and it comes back up to there, you got to gap up. And you can see it kind of gaps up to the same spot. So that's gap up, gap down. So like I said, how to use this and how to make money. What you want to do is you need to try to identify when something is in a bullish trend versus when something is in a bearish trend. And that can be a lot easier said than done. So what you want to do is you want to look for lower low and higher high patterns. You can start it at any point. You just got to take the ticker and you got to start there. So the first thing you want to look for is you want to look for a full cycle. And a full cycle can be from wherever you start it. So it can be oversold to overbought to oversold. That's one cycle. Or I can make it from oversold to overbought, from overbought to oversold to overbought. We got a full cycle, okay? Just coming back around type thing. Okay, got 10 minutes left. So that's your full cycle. Now, once you have a full cycle, what you want to look for is either lower lows or higher highs pattern. And that will give you whether you are in a bearish or bullish trend. So here we have, it is oversold here. You can start this at any point in time. You can start it here. It doesn't matter. You can start it looking back at any time, and that's how you can create your new trend. It does not matter where you start it. It just doesn't. So here we are. We're at an oversold level, and we're going to look for a full cycle. Comes all the way up to overbought. Okay, you can't long it on this one. We're starting the cycle. So when you decide to start the cycle, you got to wait and watch one. You got to monitor the stock for a little bit. So here it is, comes up. It's overbought. Cool. It came back down to oversold. Now this is what you're looking for. Now we're looking. When it breaks the 20 again, were the lows higher? If the lows were higher than the previous lows, then it is bullish on that break. So right here it was, when it broke 20, it was about at this candlestick, and then it came down, and then when it broke 20 again, it was above. We had higher lows. That means you can long on this one. So then you would note a long on this take, and then sure enough, then when it breaks 80, you take profit. Now you wait for a new cycle. So here we are. Now, can we long this again? So here it is. Here it is. Here it's coming, dropping. Oh man, this is already lower than the last low. So we can't long it again on the next break. We know that. It's lower than the last low already. Still going. It breaks the 20. Nope, we're not going to long there. It is way lower than the last low. It's even lower than this low. So we know it's in a bearish trend. And then sure enough, here it comes. Tries to make it breaks the 20 again. Lower low, bearish trend. When it breaks the 20 again, lower low, bearish trend. Now this is the shitty part, but it's the reality of the situation. And right here, it breaks the 20 and it just runs all the way up to here. So it was obviously in a bullish state. So what sucks is you wouldn't have been able to long through all this. This just isn't safe. You just didn't know if when you were up here, it was going to tank. And that sucks. You miss out on that, but it's the reality of the situation. That's the reality of these tools. That's the reality of all technical analysis. But it's not the worst thing. As it's coming up to here, it drops here, and when it crosses this 20, well, shit, that low is a sure of a hell lot higher than the last low. Now you're longing on this break, and now you're longing all the way up to here. You sell up here, it breaks here, it starts to come back up, And you could have taken the chance to long there when it curled back up to do it, or you could have waited until it crossed the 80 again to long. But you would have gotten this whole big stretch. You would have taken profit up here, and you would have gotten to buy right in down there, and you would start the stretch all over again. So you missed this, sure, but you still got all of this. And this is where to start right here. I mean, 16 to 20. That's beautiful. That's great. That's a 25% gain. Can't complain about that. And then this works on all kinds of time frames. Because, I mean, you can also go, you know, if you were unsure about this area, this is in beginning of February, you know, you could have broken it down to a lower time frame. Let's get back. Where were we? Oh, here it is. We were at this part. You know, because then you could have played the lower time frame, and when it was making this huge run up here, you already saw the higher lows pattern starting. Higher low, higher low. So if you broke down to the lower time frame, to the 1 hour, which is good for intraday, very good for intraday still, then you would have been able to get that whole run up. So using your time frames to help each other is crucial. It's super important to use your time frames together to get a smaller and bigger picture. Look at this on the 1 hour. It's in the Steph Curry moving average pattern too. 10 above 20, above 50, above 100, above 200. Doesn't get any better than that. Really doesn't. So yeah, guys, that is really it. That is kind of the basics of how the RSI is computed. It's the basics of how it's measured. The huge, huge importance of not misunderstanding oversold, oversold, and overbought. Remember, these are in trends when they become up there. When something is overbought, it is a trend. You have entered a bullish trend. When something is oversold, it is in a bearish trend. I don't know why those are just the terms. So don't think of those things necessarily as like negative or positives, you know, when it's gotten tanked like that or whatever. Now, granted, you should always keep in mind if you're oversold, you got to be keeping in mind, okay, buyers are going to come in. Buyers are going to come in soon, you know, but you're playing it safe. You're waiting for the break. And then same thing with overbought, you know, you're keeping in mind that it can sell off. Yes, it can sell off. Absolutely. It's overbought. But until it breaks the 80, you're fine. I'm going to go to questions. We got a few minutes left. Well, a gap up is when it opens up, and a gap down is when it opens down. But filling the gap, the term filling the gap, like this is filling the gap. It was here, and when it comes running all the way back up to there, that's filling the gap. And you can fill it down by gapping down. It can be used as big or long-term time frame. And you can see the tool names right here. StochRSI, here's all the settings I use for it. RSI and the settings I use for it. And this just stands for Stochastic Relative Strength Index, and then just Relative Strength Index. Well, breaking 80 on different time frames, you got to always look for the chain reaction. I mean, typically, if something, it's not going to break on the 1 day time frame before it breaks on the 1 hour. You will see it break on the 30-minute first, and then you will see it break on the 1 hour next. You'll see it break on the 4 hour next, and then you will see it break on the 1 day next, or whatever time frames you're using. There will be a chain reaction from smaller time frames to larger time frames. So it is important to always look at what's under the time frame you like and what's beyond the time frame you like, to know whether you're still in safe territory or not. Because if typically, especially if you're like on the 1 hour and the 1 day agrees with you, that's good. It's always good when your higher time frame agrees with you. And I think it's about to end. Just a heads up, guys. But I think we got all the For day trading, I'd use the 1 minute or 5 minute, and I would use the 1 day and 1 hour to get your overall trend of the stock. If you find a stock is bullish on the 1 hour, 1 day, use the 1 minute, 5 minute to trade with. Cool. I think we got all the questions. This is about to end in 30 seconds. Good job, guys. If you have any more questions, go ahead and feel free to ask me at Surge. All right. Take care. Have a good one.